Welcome back to Freedom and Prosperity Radio, the weekly radio news magazine that we put together here at the Virginia Institute for Public Policy. You can find us online at tertiumquids.org. Find out about our newsletters, the Tuesday Morning Group Coalition, and so much more. Plus, you can peruse podcasts of recent episodes through our YouTube channel. Our first guest this week is Phil Kerpen of American Commitment. Phil, thank you so much for taking some time out with us this week on Freedom and Prosperity Radio. I hope the final thawing of spring has found you well. How are you today?
I am doing great, and thanks for having me.
So talk about the, I guess, what's happening in Washington. One of these subtexts that it doesn't involve a Mueller investigation or an AG's report, as the continuation of governance happens to be going on outside of the view of the newsrooms. There it seems there was a program that the previous administration put in place regarding loans, business opportunities, and the president is currently working on relaxing those. Explain what happened first during the previous administration and what is happening right now to make it a little easier to get capital.
Well, it's consumer loans, not business loans. And
okay. I misunderstood.
Yeah,
I'm sorry.
Yeah. Well, there are probably things happening on business loans too, but that's not what I've written about and not what I've been paying attention to lately. So I can't say whether that is or is not happening. But on the consumer side, there was an extraordinary crackdown on short-term lenders under the last administration, sort of under the carryover from the last administration, because the Consumer Financial Protection Bureau has a director with a 5-year fixed term, and Obama's guy Cordray was there well into 2017. And so these rules actually came out when Trump was president, but they're really Obama rules because it was an Obama appointee who was running CFPB when he issued them. And the rules were written in such a way to effectively put the vast majority of short-term consumer lenders out of business. And what I mean by short-term consumer lenders, I mean payday loans, vehicle title loans, some pawn shop loans, and under some circumstances, that kind of thing. Short-term loans where you're getting it for a couple of weeks, and maybe you borrow $100 and you pay it back with a $15 fee a couple of weeks later, that kind of loan. They wanted to put regulations on those that essentially would have treated them like mortgages in terms of having a whole underwriting process. So when you tried to borrow $100 under this Obama rule to get you through the next payday, they would say, okay, fill out all this documentation, prove all your assets, prove all your income, show what all your other debts are, and we'll send it to an underwriter, and they'll figure out whether you can afford the $15 fee on a $100 2-week loan or whatever it might be. Of course, if you do that kind of mandatory underwriting, the business model, which is already a pretty tough business to be in, they have very high default rates. We've gone from 5 of these companies down to only 2 that are still in business in just the last few years. So if you put that kind of a requirement in, the product is not economical anymore, and you would essentially put all these places out of business. And I think for the Obama administration, they saw that as a positive. They don't want these lenders to be in business. Right. They think they're sort of unsavory. They would rather they be out of business. And so they put these basically impossible rules in. The problem is that if people can't turn to these types of short-term lenders when they're in a desperate situation, it's a lender of last resort. People don't go to a payday or a vehicle title loan company unless they have literally no other options. And if you take that away, then people in a tough circumstance, maybe they need a car repair to get to work, maybe they have some other emergency situation.
Medical,
you take away their last resort, they need to either go to a criminal syndicate, a loan shark of some kind, or they got to bounce a check, or they have to let their rent go unpaid. They basically have only worse options if you take these away. So I think it was a very ill-considered rule from the Obama administration. And now Trump's appointee, Kathleen Kraninger at the CFPB, has it open for public comment on withdrawing that rule, rescinding it before it ever takes effect. And, of course, she's being attacked and saying, why do you want these people to be ripped off by all these horrible predatory lenders? All the liberal AGs are threatening to sue her, and including yours. So she's really taking a lot of incoming fire, and they're saying she's not protecting consumers. My view is she's precisely protecting consumers by keeping these products available and not allowing a rule that would eliminate them and leave a lot of people in a much worse situation.
It's ironic to a great degree, Phil, and you laid out the case, and I know as soon as they invented the term predatory lender, it was designed to put a particular visual in everybody's head. The kind of shady, sketchy character that's got some knockoff Rolexes for sale, as well as will take the title on your car. But in many cases, these are folks, as you mentioned, that take a huge business risk in making this available. And you're talking about a part of the population that supposedly that political ideology is all about helping. How do they square the rhetoric of we want to help the poor when these are often the only folks, legitimate folks, that can be there to help them get from paycheck to paycheck? Or if they're, like you mentioned, a car repair comes up, they need brakes or that kind of thing, so that they can continue to get to work. It seems like they're working at counter purposes.
It's interesting. I think that the liberal activist types who push these sorts of rules and regulations and restrictions, and they've got a lot of states that have just outright banned these types of short-term loan payday and so forth. I think that they think that the alternative should be a much lower interest rate product that's more like a bank loan or a credit card. And that if they somehow ban these short-term loans, people will get those instead. The problem is that if people could qualify for those, they would be using them, and so these products are really for people who can't qualify for alternatives. And it's interesting. U.S. Bank a few years ago said they were going to start entering the short-term lending market, and they were going to be so much more reasonably priced. And all the left-wing groups praised them and applauded and said how wonderful it was and how they put all the payday guys out of business. And by the time the U.S. Bank product came to market, it was priced just like all the payday loans. It was priced basically the same because that's what it costs. That's what it costs to be in that business, and you can't do it for less than that because of the high default rates. And so, I think that they convinced themselves that there would be less expensive alternatives, lower interest rate alternatives, but the numbers just don't work on that. And if you ask some of them what they want, including Elizabeth Warren, they'll say, well, the post office should be the bank for people who can't get loans anywhere else, and they should be able to get loans at the post office, and it would be done, nonprofit by the government, so it would be fair, and they would be low rates. And of course, you and I know that if the post office, which can hardly even handle delivering the mail and its pension obligations and everything else, if they were ever in the lending business, they would take massive losses that you and I and taxpayers would end up paying for. But that is where Elizabeth Warren and a lot of the other liberals who are pushing these regulations eventually want to go, is the government being the short-term lender, specifically through the post office.
Well, that was going to be my next question. It's often when we see the government behave this way, it's because they're trying to become the option of last resort. We see this with healthcare as well, as they try to push that as the ruin anyone else's ability to do it. So it sounds like, though, because this is a competitive marketplace and because it really gives an option for those who are at that end of the economic spectrum, failing to create a better economy where fewer people need such a business, the better thing would be to lower the regulations on such lending institutions, perhaps create better opportunities for local and smaller operators to pop up in regions where they're needed, rather than just have nationwide chains of sort of fast food lending, right?
Well, there's a lot to that, but it's a very, very tough business, and the smaller local places, they've got a lot of the same challenges as some of these larger chains. As I said, there were 5 major national publicly traded payday lending companies, sort of community financial centers they call themselves, because they also do checks cashing and other services and so forth. I think 5 years ago there were 5. There are 2 now, and one of them is just on the edge of profitability with, I think, about a 2% profit margin. One's a little bit healthier, but you put any more regulations on, you could pretty quickly go to 1 or 0, and maybe there would be some local ones that could navigate the various federal rules and regulations. But in practice, local ones, small places, have a higher regulatory compliance cost burden. Because imagine something like these Obama rules that are probably now going to be removed before they ever take effect. But if you had a mandatory underwriting rule for everyone who walks through your door trying to get a loan for a week, who's your underwriting department if you're a storefront with that's not part of a chain? You don't have one. I mean, how would you even do that process? You'd have to imagine that places like that would almost certainly close under a rule like this.
It was also fair to say that I remember the last time we talked about this, and this has become, and you mentioned our AG, Mark Herring, but also Mark Warner and Tim Kaine have also taken shots at this piñata as well over the years. It has often puzzled me, Phil, and maybe you can help us with this. Most of the things that they would point to as bad behaviors in these industries are things that would be considered against the law or untoward business practice, punishable in some way, shape, or form, either by fine or by citation anyway. So why not just punish the things that are illegal business activities when confronted with them and not worry about whether or not they're preying on somebody, because again, it seems like their attitude is we're not smart enough to take care of ourselves.
Yeah, I think that's right. Look, I mean, we've all seen some really horrible horror stories about people who got crammed with a bunch of loans they didn't understand, or with they just escalating revolving ones, and they got trapped up and that kind of thing. And of course, we should try to avoid that. And if it happens fraudulently, people should be punished. And there are already tons of federal and state regulations that apply. I think that the assumption, though, that by and large the customers who take out these types of loans don't understand what they're doing is completely wrong. There's no evidence that that's true, and in fact, the scholars that have looked at this found the exact opposite. It's pretty incredible. There was a professor at the University of Pennsylvania who went undercover a few years ago at a checks cash place in the Bronx, and then at another one in California. And she expected to see that people were taken advantage of, that didn't understand the pricing, and she found the exact opposite, that people knew exactly what all of the products were, that they understood the pricing, that they preferred them in many cases to bank pricing because all the prices were posted on a big board and they knew exactly what everything cost, instead of all the mystifying fees that you encounter at banks that you don't necessarily expect or understand. And she found that most of the people who use these products are on a tight budget, and they watch every dollar, and it makes sense to them. It makes sense in their circumstances to use these products. And she also found that a lot of people get a much higher standard of customer service in sort of storefront financial centers than they do in banks, because they know them. They're able to transact with them on a reputational basis. They know their names. They know their families. It's sort of in some ways more similar to what banks used to be than what they've become. And so I think that the assumption from the liberals that the customers of these places don't know what they're doing is wrong. It's been disproven by and large. Where there are circumstances where people don't understand what they're buying, or they're taking advantage of, or what have you, you're absolutely right. There are all kinds of existing federal and state laws to deal with those circumstances without doing something like this Obama rule for mandatory underwriting that would really, I think, it would have completely destroyed the business model. And I think that a lot of the liberal activists probably thought that was a good thing. They wanted to put all these places out of business,
sure.
But that's not protecting consumers, because that would leave an awful lot of people who don't have any other option in a really bad place. And so I'm glad that Kathleen Kraninger, the director of the Consumer Financial Protection Bureau, is withdrawing those Obama rules. I think she's doing exactly the right thing to protect consumers. She's being attacked by AGs like yours. She's probably going to be sued. I just hope that she'll stay firm, and if the attacks start to be directed the president's way, I hope he'll stay firm on this also, and not sort of do the easy thing, which is to say, oh, people don't like that industry, so let's buckle and have the government destroy it.
Well, and define who the people are that don't like it. I can imagine if I'm Bank of America, I don't want people going there for lending, especially if I have to work as a bank under the yoke of massive regulations. And speak to this on an abstract, though, Phil Kerpen, president of American Commitment, that it is often the regulatory state that gives the growth of the bureaucratic application processes that also tend to allow for massive loopholes. We often hear people complain about insurance companies that take your money and then have a million different ways to not give it back to you if you ever need to make a claim. They feel that way about the 20 or 30 page bank loan applications and things like that. Much of that, if I'm not mistaken, is driven by compliance with regulatory code, isn't it?
Oh yeah, I mean, healthcare, and financial services are probably the two most regulated sectors of the economy, and that's why you always deal with so much bureaucracy when you're dealing with a bank or with a health insurance company. They've got, there are all these rules that are supposed to help you, but in practice they just create this maze of different requirements and confusing statements and so forth. I think that you look to relatively unregulated businesses, and you get a lot of you look at say mass market retail. I mean, you have intense price competition, and things tend to get less expensive. You look at the areas with government subsidies, government regulations, government controls, healthcare, education, financial services. To a certain extent, it's a little bit different because it is more intensely competitive. That's where you tend to see rising prices. And so, look, I think that a big reason that banks, by and large, are not in the short-term lending business is that the regulatory hurdles for them they consider insurmountable. But I also think a big part of it is just that it's not a great business. They don't want to be in a business with such high default rates, and that's why sort of the non-banks have filled that vacuum.
Well, I appreciate your outlook on this. This is one of those things that becomes a piñata around election time under the guise of I'm trying to defend you from these horrible mustachioed evildoers who are coming to take your family and run away with all your money, when really they have become the last resort, especially in places where unbanked communities are very high, especially Latino communities and places where a distrust of banks comes from sometimes the communities they moved here from because the banks were the government and the government was the enemy, thus why they came to this country in the first place. So I can see where the trust would be much higher for just a guy in a storefront in their neighborhood. And I appreciate you laying this out. What is the time frame on these changes in regulation?
Well, they're in a 90-day comment period. It probably started about a month ago, so we're probably about 2 months away from this being finalized. And of course, when it is finalized, then we'll get the litigation. And I'm always amazed that they keep finding judges who say that the Trump administration can't undo things by regulatory action that the Obama administration created that way. And so who knows how that'll all work out. But I hope that they dot all the I's and cross all the T's, and they're able to finalize this and withstand any political blowback. AmericanCommitment.org is where you find Phil and his team there. Thank you so much for taking some time out with us this week on Freedom and Prosperity Radio, sir. All right, my pleasure. Have a good one.
Up next, Matt Pinsker back from the southern border of the United States, and he will tell you what is really happening with our border crisis and what he's seen down there and what needs to happen next on Freedom and Prosperity Radio.